Welcome, my friends, to Heritage Wealth Planning YouTube channel. Guys, real quickly, just talk. I'm only going to take a few minutes to talk about the tax law changes for 2018 and what you need to be taking advantage of. All right, so we got a lot of new stuff out there for the Tax Cut and Jobs Act of 2017 that's going into effect now in 2018. And 2019 will be the year when the actual 1040 changes. So not this year now. So we're still dealing with the old-fashioned 1040 that we're dealing with, which is where your AGI, your adjusted gross income, flows to line 37. And then you flip it over and you can see your exemptions, your deductions, your credits and whatnot. That's going to change next year. Okay. So the following tax year. So as you file your taxes in 2019 for 2018, you're still going to use the same 1040. It's the following year you're going to have a new tax form. So we won't get into that till next year. There are three big changes, though, that you need to follow. And if you're not using this and taking advantage of it, you're just wrong. All right. So the first thing and foremost, and forget, if you like what you see at Heritage Wealth Planning, go ahead and I think it's that side when I'm live. Go ahead and click on the subscribe button and then hit the notification bell, which I think it might be next to it. I don't remember. Anyway, the notification bell will be notified for future content as well. So subscribe, bell to be notified. Subscribe, bell to be notified. Subscribe, bell to be notified. That actually rhymes. All right. So first and foremost, the increase in standard deduction is huge. The vast majority of people do not file itemized taxes anyway. All right. So all this talk about deduction is just on the extreme. You know, maybe 15% of American taxpayers actually itemize anyway. So anytime they talk about a deduction for this or deduction for that, unless it's on the top of the line deduction, like a SEP IRA, for instance, is a top of the line deduction. I think the school teachers can write off $500 and stuff. That's above the line deduction. That simply means above the line 37 of their 1040. So unless it's above the line deduction, all the talk about deductions don't mean anything if you're itemizing. I mean, if you're not itemizing, and the vast majority of people don't itemize. So if it's a below the line deduction, i.e. on page 2 of the 1040, it doesn't matter unless you're itemizing. All right. So all this talk about you can deduct this, you can't deduct, it doesn't matter if you're not itemizing. All right. So now because of that, the increase in standard deduction is going to affect even more people to stop them from itemizing, because now old Josh has a $12,000 standard deduction and my wife has a $12,000 standard deduction, which means we have $24,000 of income tax-free. If you don't have a mortgage, a big mortgage expense, if you don't have big real estate expenses, and you don't have big charitable contributions, medical expenses, yes, too. But if you don't have those four things, and I'm talking big, it's got to be in combined over $24,000. You are not going to itemize, which means the standard deduction is huge for you, gigantic. A married couple filing jointly who's under the age of 65, they have $24,000 of standard deduction. That means they can have AGI of $100,000. And you know what their tax bracket will be? 12%, because they'll be taxable income will be a $76,000. So if we factor this, say you're married filing jointly and you make $60,000 a year of income, let's get my trusty calculator here. You got $60,000 of income and we do 24,000. That means you're going to have $36,000 of taxable income, which keeps you in the 10% bracket. A couple $1,000 more, you'll be in the 12% bracket. But what do you do? So take advantage of the higher standard deductions. If you are not itemizing, take advantage of it. Start looking for ways to move money from your traditional IRAs, your 401ks, into the Roth. Contribute to your Roth 401k. Contribute. Anything you can do to move money at a 10% clip over here is going to save you boatload in the long run. Simply because when you hit retirement, you can't do that. I mean, you kind of can, but you're going to have limited options of how much you can write off at that point, simply because you're going to have required minimum distributions on your IRAs and 401ks. We want you to start taking advantage of the tax code now to slowly, if not quickly, depending on your circumstance, move money from point A, traditional accounts, TSP, 403Bs, 401ks, what's the other one? 457s. 450. I'm missing one. But anyway, move them from qualified retirement plans over to your Roth IRA. Even if you only do it at a clip of 10,000 a year, 5,000 a year, it doesn't matter. Just start doing it to take advantage of the first benefit of the new tax code, which is a mass increase in standard deduction. Do not get suckered into thinking you're going to itemize. I'm telling you, most people don't, and I bet you don't either. Number two, the reduction in the tax rates. So the reduction goes from 10 to 12 to 22, whereas before was a 10, 15, 25. So the reduction in the tax rates are extraordinary as well. So not only do you have a higher standard deduction, you have a lower tax rate. Again, take advantage of the lower tax rates and the higher standard deduction. That's going to squeeze out more income from you that's taxable. It's going to make it less taxable. And the one that is remaining that is taxable will be taxed less. So start moving money from your traditional IRAs to the Roth right now to take advantage of the higher standard deductions and the lower tax brackets. Please start doing that. All these tax laws are sunsetted, which simply means they have a 10-year to 2026, I think it is, a 10-year time frame before it reverts back to what it was before. No idea what's going to happen at that point. But you cannot sit there and say, I'll do it later because these tax brackets are going to be there forever. No, they're not. They're just simply not going to be. They could if Congress does something, but by then we'll have probably a new president, we'll have a new Congress. Who knows what they're going to do? Take advantage of the tax breaks you have now. Number three is if you're a small business owner, a business owner of any sort that has a pass through. So you're an S corporation, limited liability company, sole proprietorship, anything that passes through your income from your business that passes through to you, it flows to your 1040. That's what a pass-through entity is. It just means you make money out of the business. You don't pay business tax on it. It goes to you as an individual taxpayer. And I talked to Mike Kelly the other day, CPA. The 199A tax deduction is just simply incredible. You get to write off 20% of your business income. Now, there are income limits. I think he said $357,000 if you're married filing jointly, and half that if you're a single taxpayer. So the example we were using is if you're a plumber and you got $100,000 of business income, you can take $20,000 off right out of the gate, without question. You're only taxed on $80,000. Oh, no, you're not even taxed on $80,000 because you have the standard deduction. So if you have $100,000 of income, you got $20,000 you can write off right out of the gate. That means $80,000 is your AGI. Subtract that by $24,000. What's that? $56,000 of taxable income. You're going to be halfway in the 12% bracket, but yet you're living off $100,000. Yeah, that's not too shabby. So what we'd want to do in that case, so Mr. Plumber, $100,000 of gross. You take $20,000 off the top because it's 199A and the new taxes write-off because of the tax law that was just passed last year. AGI is $80,000. Take your two standard deductions. Your taxable income is $54,000. That gives you $21,000 that you can move from a traditional IRA or 401k, put it over to a Roth before you are into the next tax bracket. So you have $56,000 in this example of gross of taxable income. You take a $21,000 from your Roth, from your traditional to your Roth, convert it to a Roth. That's $21,000 of taxable income added to the $56,000 you had before. That's $77,000, my friends, of taxable income. You're still in the 12% bracket. Now you just moved $21,000 over to a Roth. That is a smoking deal. Let's just say you did $25,000. All right, $21,000 is still taxed at 12%. The next $4,000 will be taxed at was at 22%. So what do you do? And that's the thing with the marginal tax brackets. The whole thing isn't taxed at 22%. It's just the amount above the $77,400 that puts you into the 22% tax bracket will be taxed at the next marginal rate. So don't let us say, I can't go above the next bracket because I get no, it's just for the next dollar. Whoop-de-doo. I mean, my goodness, don't sweat it. If you go a couple bucks over the next tax bracket, it just who cares? That's all I got, my friends. So I hope this helps. I love the new tax bill. I love it. Absolutely. Then, they got rid of the individual mandate. That will happen in 2019. And again, the tax code itself, you won't see the changes on the 1040 until next year. Next year for 2020, you'll see it for 2019. But I'm a big fan of it. And you doggone better be taking advantage of it simply because it's not there set in stone. It's only there until sunset provision in 10 years. And it seemed like I had something else I want to say on that. Nah, that's all I can think about now. So thoughts, questions, concerns, put them in the comments down below. Don't forget to subscribe. If you subscribe, hit the notification bell. Share the videos, please. YouTube loves it when the videos get shared. It makes people say, oh, the YouTube algorithm seers say, oh, that guy's getting some content, sharing to spread the news. So we'll help him spread his word because other people might want to see it as well. So do me a favor, thumbs up, comments, and of course, share the video as well. We'll see you next time. Thanks, guys.